This is Pete Moore on Halo Talks NYC, on location San Diego, Ursa 2019. I'm here with Charles Adams. We're going to be talking about finance, how to grow your business, how to do a good loan deal from Texas Capital Bank, straight from Dallas, Texas. Charles Adams, welcome to the show.
Thank you, sir. Glad to be here. Appreciate the opportunity.
Awesome. So as, I've been in this industry 20 years, and people used to walk into a bank and try to explain to them, this is how the health club industry works. Mm-hmm. This is how we buy equipment. This is how we sell memberships. And some of these groups never got to the point where they could get a loan because like all these commercial banks had no idea what the, how to even think about this business. Now we've got groups such as yours that have hundreds of millions of dollars of specialty finance money that says, look, I understand the industry. I've had success. And, we'll want to put money out there and help great operators grow. So why don't you talk about, who Texas Capital Bank is, because it's not just for the state of Texas.
That's right.
And then your background, and then we'll go free flow it from there.
Sounds good. Yeah. So Texas Capital Bank is a almost $30 billion publicly traded bank. We just had our 20th anniversary. Super entrepreneurial organization I'm happy to be a part of. And we are a specialty lending group within the bank focused on the consumer retail space broadly, but really multi-unit models that generate their earnings out of four walls or a network or a dealer relationship or license relationship. So restaurants, fitness, fits squarely in that bucket. So we have about $175 million worth of exposure to the system or to the industry. And we're working with mainly scaled operators and national branded systems, franchisees in those systems.
Okay.
And we're helping them grow their business, from 10 to 15 units to that next level by cleaning up their capital structure and providing some growth financing.
Got it. So talk about your background and how you, it sounds like you got a pretty awesome job inside of a more traditional financial institution, regardless of how entrepreneurial a bank can be. You can kind of allowed to walk around this industry with your golf shirt and say like, wow, I might have won the lottery inside of here, being able to do this industry.
Yeah, it's good. So I got exposure to fitness through my prior role. I was with another financial institution working in the capital market space, structuring and syndicating deals for the private equity world and the restaurant world. And when there were a few of the earlier bank-backed fitness deals coming to market in 2014, 2015, I happened to work on one.
Okay.
And at the time, it's pretty incredible. 5 years ago, almost, what a difference that can make. At the time, traditional commercial banks, like you said, didn't know the space, didn't understand how to look at it, didn't understand, multi-unit businesses outside of restaurants, which is a very actively banked space. So,
right.
We took the learnings and the understanding of unit level economics and brand value and underwriting operators and applied them to fitness and found that there was a lot of opportunity. And it's pretty crazy. Fast forward, 5 years, I'm at a new institution. And as part of a group that initially did focus on restaurants and other similar concepts, we've now been able to carve out a nice niche, applying some of those same analytical approaches and underwriting approaches to the fitness space.
Did you go there and then like kind of grandstand and say, hey, we got to get into the fitness industry, or they were actually hiring and you're like, wow, actually like somebody just wrote my job description?
No, so I had, like I said, I worked on that first fitness deal. I actually didn't work on another fitness deal for a little while, but then at the time that I joined Texas Capital, we were building this group out to broaden the mandate. And one of those avenues was to explore exactly this space, the multi-unit fitness operator world. Nice. And now, with the success that we've had in the operator world, we are now looking to expand elsewhere within fitness. And that means, other players that touch the industry, whether it's kind of on equipment or distribution or other kind of vendors and providers. So
nice. So let's talk about, if I am a operator, I got 5 clubs. Let's call it, Halo, because I like that term. It's called Halo Fitness. I come to you. I've got, on average, this is a non-binding verbal term sheet that I'm asking for from you.
Sure.
So I got $1 million of EBITDA per location. I got 5 locations. Let's say I have $5 million of EBITDA, and I've got like $3 million of revenue per location.
Business.
Thank you very much. Yeah, it's called Halo Fitness. Yeah, I started it myself. Yeah, I got 3 years of audited financials.
Even better.
Same store sale comps, I don't know, probably up about 4.5% per location. I got great leases.
Good membership rolls.
Good membership rolls. Not only do I have good memberships, I have good members. And they smile all the time. Attrition rates, it's about 3% a month. Anyway, so I got a decent business. I want to go build another 5 clubs. I come to you. We bump into each other. You're like, hey, I do this. So I'm like, I didn't know you did this.
Right.
That's awesome. All right, tell us how the process works,
Sure.
and then how you and I will non-bindingly give some parameters on what the multiple of how much money you're going to give me and.
And this is a good segue into kind of the differentiation of kind of our approach and how folks.
I'm going to shop the deal, so give me real terms. Okay,
of course. Cool. So a good segue into why we're differentiated and why some of the folks that are looking at this space are differentiated. Our first question is not going to be what's your audit look like, what's your consolidated financials look like. First question is going to be to get to know you and your business. Make sure that you have what we call owner-operator mentality, and that doesn't mean that you're the guy at the front desk or building the unit yourself necessarily at this point, but that you've built a team and a culture around you that has that ethos and that value proposition or value focus on being a true owner operator and knowing what makes this operation tick at the unit level. Second question is actually not going to be, again, what your audit looks like, what your consolidated financials look like, but rather what your unit level financials look like. And so what we do is we start from the bottoms up because we recognize that these businesses, especially in the multi-unit world, or whether it's multi-product, multi-unit, everything's driven from the individual business line up, right? And that can come in the form of an individual gym and aggregate up to a 5-gym business. But each unit has its own story, has its own management, has its own trainers or staff, has its own membership issues, has its own location. So we are bottoms up. And
Halo Fitness doesn't have that many.
Doesn't have that many.
Yeah, you can check those boxes.
Got you.
Yeah, but this is good because it's an interesting sequence of hey, I'm not applying for a loan. I'm applying to be to understand you, what you want to do, and then we'll talk about your business.
And that's what we're all about in our group, and that's what the bank is all about, right? It's a partnership, right? We're looking to we talk about selecting partners as opposed to collecting clients, right? And so we want to make sure that we're a good fit.
Let's get that line.
Selecting partners versus collecting clients.
Selecting versus collecting.
That's right.
I like it.
And we want to make sure it's certainly a good fit for you as well, right? And so once we've established that you're a good operator, you know what we're doing, we're a good fit for you organizationally, and on the unit level analysis that there's consistency in what you're doing, replicable across your units and across years, then we can get to the structuring. And we're cash flow lenders, right? And so at the end of the day, the collateral value in these boxes, most folks know that the residual value is de minimis. And so in a downside scenario, there's not a whole lot of value there to pay us back. And so what we're really looking at is what kind of a structure can the cash flow that's recurring support. And so we start bottoms up and build from there.
And then, so you're doing specialty finance. You're doing, what a term that we're going to use here for our listeners. We'll give them all the different definitions. But if we do a unitranche loan, then I'm basically saying, all right, I'm the only debt provider. So uni would be one, like a unibrow. We got one brow. You got one tranche, unitranche.
Right.
And that unitranche is going to be the maximum amount of debt that I can put on this business is probably what you're going to get in the unitranche instead of having a senior debt provider and a secondary.
You're definitely going to get more.
Yeah, a mezz and and then preferred equity and then that to equity. So as you look at this industry, and obviously things ebb and flow, but going back to my Halo Fitness, where I got 5 of EBITDA on 15 of revenue. What are some of the things that you would see, or you'd say, hey, if all checks out, this is kind of like what your business could borrow borrowing capacity.
Yeah, so you're looking probably on a unitranche deal somewhere between 4 and 5 times.
Okay. And
so, terms on that, the senior piece, from an amortization perspective, you're looking at kind of 35 to 45%, 35 to 50% amortization on the senior piece, and obviously 0 or de minimis on the junior piece or last out. From a rates perspective, kind of blended 5.5 to 6.5, let's say, or 5.5 to 7. So that's in 5-year deal, right? That's typically what we see. I think we've seen some folks ask for on the oddball deal, you maybe get something a little bit longer. But on a unitranche or a senior-only deal, you're going to get 5 years from a traditional commercial lender. And maybe if you have some mezz or some other traditional junior capital behind you, you'll have 6 years on that or more.
Got it. And then, but are you guys also doing like no amortization debt deals, or how do you
We
view
do
those?
not. We'll play in unitranche deals as the senior piece or the first out piece, but our shop is the senior secured cash flow lending shop. So we're going to have
you do have a
amortization
payment.
on all of our deals.
Okay. All right. I'll need to get comfortable with that with my CFO
Sure.
after the Halo Fitness.
Well, and we're we have the flexibility depending on the transaction in the business to kind of stair step things like amortization.
Right.
And then on the rates, I think most folks that are being smart and competitive out there are going to look at things like the leverage profile over time and allow you to potentially earn into a better rate structure in terms of a grid pricing scheme. And so you may start out at a level that's, appropriate for your risk profile. And as the business de-risks and grows, as you diversify, whatever it may be, EBITDA grows, you can earn into a better rate.
And then from a standpoint of, how long it takes to get through your process, obviously, like us, I'm sure people come to you and be like, hey, I've got, I need to do this
Tomorrow.
and tomorrow, or like closing on this deal in like 3 weeks. I'm like, could you call me a little bit early?
Yeah.
So what's it like a reasonable process that people should expect? And obviously you've done this many times, so there's a like a blueprint on here's what you need to provide us, here's how we view it. So it could give some insight.
Yeah, it's all going to be dependent on availability and timing of delivery of information. But typically we'll put out kind of an initial diligence request and kind of work through that for, let's say, a first 2-week period. Come up with kind of a term sheet and/or commitment. Come back to you, kind of negotiate maybe for a week, and then once things are signed up, if it's a single bank deal, right, we can kind of close pretty quickly. So you're looking on a single bank deal somewhere around 45 days. On a syndicated deal, anywhere from let's say 60 to 90 days, because there is a process component there where after our bank gets comfortable, we go out with a strategy to the market and position it with other lenders in the universe that are looking at fitness companies. And, right now that process is typically 2 weeks of diligence for those banks and then kind of a week of closing and logistics.
So when you look at the difference between operators, my company that I was, we're using as an example here, on a serious note, Halo Fitness is like, okay, Pete Moore, he built the clubs, he's got personal guarantees. And then you got, let's say, we had the guys from Choose Fitness here, 30 minutes ago. They got, 20, 30, I don't know how much. They got $30 million of private equity, institutional capital. So, do you talk to both of us?
Yep.
Do you talk to one of us? Do you say, hey, look, you're kind of, I've been in this industry, I'm speaking in third person for you, saying like, look, I know what the risk profiles are here, and I'm going to, take those into account. And should talk about that. Yeah,
you're definitely looking at different risk profiles there, but neither of them are precluding us from looking at us or someone like us from looking at those kind of opportunities. I think a couple of things that we would consider. You have obviously more sophisticated and deeper pockets backing you when you have a more institutional player behind you, so you don't need things like to consider personal guarantees and all that stuff.
Right.
However, I think what we're ultimately looking for is that owner-operator mentality, and even if there is a sophisticated financial buyer or financial partner behind it, we still want to know that there is an owner-operator involved in the business, right? And so we are underwriting the owner-operator as much as we are underwriting the financials. As far as kind of different concepts and models, we cover franchised, non-franchised, privately held, single market opportunities as well, right? And so we're not simply focusing on one category or one type of business model.
Gotcha.
And I think most folks in the space are looking at it the same way, in the sense of sponsored, non-sponsored, franchisee, franchisor, all of the above.
All right, I'm going to put you on the spot here, because this is a big topic that comes up in every deal.
Sure.
Somebody comes and says, hey, Pete, can you value my company based on EBITDA, adjusted EBITDA, four-wall adjusted EBITDA?
Nope.
Or EBITDA adjusted, embedded based on the future growth of some clubs that I just bought a piece of property on, and I have some some stakes in the ground that have little flags on top of it.
Yeah.
Which one am I allowed to use if I come to Texas Capital Bank?
So that's an interesting question. I think
Thank you.
The answer I like to give and the answer that I like to work through is it depends on the data, right? So how many clubs have you opened? How many clubs have you bought? How have those clubs performed? How have those clubs ramped? The more you have, the more comfortable I can get that you can replicate that again. Okay. And the better I can get at giving you credit, and the more reasonable it is to give you credit for that. And so the answer is it depends on your platform. Smaller platform, smaller set of experiences, probably less likely to get comfortable with a pro forma forward-looking number. However, if you're 50, 60 plus units, you've opened half of those and bought half of those, you have a good track record of either improving or growing EBITDA or ramping pretty quickly, then there's a reasonable case to be made that you're going to be doing that again and easily replicating that. So those are the situations where you can, as a commercial lender, you can get comfortable with pushing a little bit. Right now, I don't think it's prudent, and we don't feel it's prudent to take, let's say, a forward-looking 12-month pro forma embedded EBITDA number.
You added one to mine, that was good. It was helpful.
Yeah.
And now I'm going to add another calculation.
Sure. It's and I think the other thing you mentioned was four-wall EBITDA, right? So pre G&A. And I think that's an interesting one. We're seeing it in other spaces we work in where people are certainly on the equity side valuing business based on that, right? Yeah. Taking away the G&A and saying, look, what do these units really generate, right? Mm-hmm. And that's an interesting way to look at it. I think the reality is that from a lender's perspective, the G&A component is such a critical component, especially as these businesses are growing, that you can't disregard it. And so,
well, I think also people's memories of how much leverage is reasonable to put on a business. That seems to always move with the tide. Your memory's short. We said that banker's life is 15 years long and 5 years deep. It's like I don't remember what happened the last term, but I do. I know you do. But I think at one point, just to kind of encapsulate what you said, it's basically to kind of re-quote you, is basically say, look, I'll give you credit if you deserve and you've proven it. I'll give you some additional credit for your adjustments. Exactly. But you got to show me that you did in the past, and I need to know if you got a prototype. Like I want to know you actually just replicating the prototype, and that's something that people say to us, like, oh, none of my 15 clubs are the prototype. Like the 16th, like, Charles, this is the one. Trust me, like I've learned.
Yep.
But I think one is, understanding the debt capacity of a company, and also understanding that when you get mad at your banker or you get mad at like somebody like Charles and say like, why can't I get 4 times and I'm only at 3 times? Like, look, like your business might be worth 5 or 6 times, let's say on average. Half of that I'm taking the risk on, and you got to take the other half. Like, I'm not here to give you like 80-20. Right. You own 80. You own 100% of the company. I, Texas Capital Bank, now have 80 cents of the dollars at risk, and you put in 20, but you own 100. Like you gotta stop and think about that before you start nickel and diming people on a term sheet.
And I appreciate that perspective because that all goes back to the partnership point, right? Is we're looking to develop, cultivate, and grow partnerships. Mm-hmm. We're not a transactional shop, and I think the folks that are out there that are going to be, in concepts and businesses that have staying power, they're going to find partners as opposed to transactions.
Right. So, as you see things moving forward, what's your biggest concern, if you have one, related to being in a position where you are lending money to competitors in an area?
Yeah, so I would say the biggest concern is that right now there's a lot of explosive growth, a lot of really interesting things that are captivating people. And there's it happens to correspond at a point in time where there's a lot of money coming into the space and a lot of interest on the investing and lending side. And so what that tends to do is allow for people to pursue growth for growth's expense, right? And growth's sake. And that may lead them to do things that are potentially stretching their organization, stretching their capacity, stretching what they need to do, right? And so I think one thing that we recommend is, when folks are out there and we're competing and there are really aggressive competing bids out there, we like to remind them to really focus on the partnership angle and really focus on what they need to stay true to what their organization does and how they serve their clients. And, maybe you do need to stretch because it's going to really evolve your concept or your business. And maybe that aggressive deal is right for you at this point in time. I think the interesting overlay right now is, by pretty objective measures, we're late in the cycle. And so each day we're kind of close to the next contraction or whatever you want to call it, to whatever degree. And so when we see folks that are like, look, I can get a turn more leverage. I don't necessarily need it, but I can get it. That's your decision to make. We don't necessarily feel that that's prudent. We're going to go out there and we're going to help you understand from our perspective and what we see in the market, what's prudent to position your business best to do what you do best.
One thing that, look, at the end of the day, and this is what I tell most people when they come and meet with us. And I'm like, look, I'm not getting you the last dollar deal, okay? Because there are going to be other parts of this transaction that you are going to want us to prioritize, whether it's like if we're selling a company, it's going to be like how much money is in escrow account. It's going to be, what's your liabilities? What's your transition services agreement? Is this new group going to really take care of a legacy that you built? We might have to trade off certain things. The one thing that I find that I think collectively we need people to understand when they're looking for a loan is, by me not maxing out your leverage, it's not me negotiating with you. It's me potentially saving your business. You just don't know it yet.
That's right.
So I'm trying to do a deal with you, and if someone's going to give you 5 times, I got my guttural response to that is usually dude, take that deal. I'm not matching that deal because that deal does not make sense to me.
Right.
However, if you come back to me and you say, hey, look, this is what this other guy's done, and I explain to you why I'm not willing to take that incremental risk, one of the best things that you can get from a bank or you can get from an advisor or you can get from a landlord that you're trying to do a lease with is here's something that you don't want to hear.
Sure.
Right? Because that makes you understand how the market works.
Absolutely. Yeah. And we're all about providing that, transparency to our process and what we're seeing in the market and how it relates to your opportunity at hand and what's most prudent and helps best position your business.
Yeah. So in closing here, give us some a quote that you like or a mentor that said something, or if you got an atomism, that's this is what this guy says all the time. What's your stick?
That's a good question. I think one that's on my mind lately.
We'll take that one.
Related to what I just said about kind of aggressive deals is pigs get fat and hogs get slaughtered.
Yeah.
That's one that I hear floating around. Yeah. Actually, my colleague says it quite frequently, and I think it's pretty relevant, right? And, there's a line to being aggressive, and beyond that, you're potentially stepping into some uncharted, uncomfortable territory.
Yeah. So I think people really need to understand that, when you're looking for a partner that you want to grow with, the best thing you can do is get a good partnership in place and then achieve results, share those results. Right. Have failures, share those failures. So when you call up and you need a favor, or you got to say, hey, look, this is what's going on in my business, XYZ, a competitor came in across the street. There was a fire in the parking lot. Right. There was something happened. You got to understand that you're, like you just said, you're not doing transactions here. It's not like I'm borrowing money from you and I'll see you, and just give me a Dropbox that I can, drop my interest payments in. There's people behind these deals. There's people behind, making sure that they are successful. You're looking for principal preservation and return, and people want to build big businesses, with appropriate levels of capital. So let's work on this together. Go Halo, Texas Capital Bank. We are here. We are open. We're building relationships. We are not doing transactions. If you want a transaction,
somewhere else.
Go somewhere else. All right. Thanks for coming on, bud. Good talking to you.
Thank you. Cool. Appreciate it.